Futures trading. This is a mystery to the retail trader, but a favorite in institutional firms and professional traders around the world. So today we're going to talk about futures contracts, what are the benefits, how to trade them, and how to take advantage of this product type for daily cash flow as a day trader. Let's jump right into this video. Okay, so here are the benefits of futures trading. We should start here first. Number one, there's a low capital requirement to get started. Whatever money you have saved will likely work, and there's cheaper alternatives to the main futures products that you can take advantage of. Number two, there's no pattern day trader rule, so you don't need $25,000 in your account to day trade futures in the US. Number three, these are very liquid markets traded by professional traders. Number four, you can read order flow to gain an edge and advantage in your trading. And number five, they're perfect for day trading, and you could trade the downside and the upside in a market. All you need is movement, and you could capitalize on that. You don't have to just trade the bull side. The goal with futures is daily cash flow generation and not portfolio growth. So let's start and talk about what are futures so we can demystify this process. What is a futures contract? It's an obligation to purchase or sell an asset before its expiry date. Futures contracts expire either quarterly or monthly, depending on the product. You could trade equities, commodities, metals, Bitcoin and cryptos, and much more. The important thing about futures is how they settle. This means that they actually expire and have a shelf life. Like an option, they're not good forever. There's two different types of settlements. One is called physical settlement, which means at the end of the expiry of the contract you're trading, you will have to take delivery of the product. If you hold one futures contract on oil long, you'll have to take possession of 1,000 barrels on expiry. The second type are called cash settled futures. These are all your equity products like S&P 500, NASDAQ, and Dow. This means that on the settlement date, whatever the profit you're up or down is realized. But as traders, we hope to never settle into these contracts, and it's important to sell them before expiry. At the end of the day, like an option, we're just using it to rent the price movement and to profit on the upside or downside. But we don't hold these positions overnight, and it's a short-term cash flow play that you do intraday. The best part about futures is that anytime throughout the day, you can buy and sell them with very little effort, and it's super easy to do. There's always a market for them, they're liquid, and you can get in and out of positions relatively quickly with little slippage. Margin requirements. Now this part is very interesting. Margin is often interpreted as how much money you're borrowing, but margin is how much money you have to put down to open a position or to initiate the trade. For the S&P 500 futures, which is called the ES contract, you only require $400 of capital at your broker to purchase one single contract. Now brokers regulate how much margin you need, so it's important to ask the company that you're planning to trade with on what their margin schedule is. If you plan to hold between 5 to 6 p.m. in the futures market, which is the only time that it's closed, because it is a 24/5 market, margin increases to $4,000 per contract. Because this is the only time the futures markets are closed, you need to put up more money to hold the position through that. However, at TRADEPRO Academy, we day trade futures and we don't hold into the closure. Every day is a new opportunity. Whatever we buy, we sell. Whatever we sell, we buy to finish flat for the session. So here's what you need to trade futures. Number one, you need a strategy with an edge. Oftentimes, following order flow or knowing when institutional traders are getting in and getting out is enough to build a quantifiable edge for your strategy. Number two, you have to focus on risk management because these are highly leveraged products. You can't purchase a futures contract for a short-term trade, fall in love with it, and end up holding it for 9 months. You really have to exercise discipline, caution, and be focused on risk management. Now, this might all sound complicated to you, and if you're just starting out, the futures market is a whole new world. But in the professional industry, day trading at prop firms, institutional companies who hedge out their portfolios, all use futures. It's a very liquid market, and the ES, which is the S&P 500 futures contract, is one of the most heavily traded contracts in the world. So how do you get started with trading? We have a full course to teach you how to gain an edge in your futures trading, how to open your brokerage account, set up your charts and software, how to build a strategy with a defined edge, and how to get started and trade with a team of professional traders. Also, we have access to a free trading room. If you visit community.tradeproacademy.com, you can get started now and see what we're about. At the end of the day, whether you decide futures trading is right for you or not, it's worth to have a look, because this is a great day trading mechanism to generate cash flow with. So check us out and see if this is right for you. If you have any questions, please pop them in the comment section below and I'll personally answer them for you. Thank you so much for watching. Be sure to hit the like button and subscribe to our channel and hit the notifications bell for more great content. That's all I got for you. Manage that risk, trade like a trade pro. See you next time. Goodbye.